Bristol Myers is at its 52-week low, looking significantly undervalued. This pharmaceutical company has a lot of upside and a lot of factors and metrics that we love that we're going to run through. As always, we will look at the historical performance of the company. We'll jump into their income statement, their top line revenue, as well as their bottom line net income growth. We want to see the safety of the dividend as well as the health of the company by looking at their total cash versus their total debt. And we will also compare them on a total return versus some of their well-known competitors. And we want to take a look and see what movements are the institutions doing, whether they're buying or selling. And as always, we will take a look at that dividend safety, some very important financial metrics that you need to understand for BMY. And we will run it through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given that investor margin of safety. Now, for those that don't know, it is a pharmaceutical company. It has been hammered down 33% year to date, and we will shortly touch upon their earnings as well. Right at their 52-week low, offering a yield nearly touching 5%. Now, investors who have been holding the company over the last 10 years would in fact be down 4%, and as we can see, very recently they did reach their all-time high over the last 10 years at around just over $80, so they are nearly half of what they were not too long ago. Now remember, past performance isn't indicative of the future, and we are looking to see whether we are looking at a very cheap price for BMY and whether we can see not only their share price double or even more, go way past the all-time high, but also to see that yield on cost grow to double digits. So let's jump straight into their income statement, and as always, we do like to see 3 to 7% growth on their top line year on year. December 2018, 22.5 billion reported, and we can see their most latest annual report in December 22, 46 billion. So more than doubled their top line, which is very, very positive to see some very nice growth. And on a more granular level, what we do in fact see is from 2018 to 2020, there was some nice growth. And then it did slow down very slightly in 2021 before remaining fairly flat. So whilst there has been nice growth over the last 5 years, there are some slight inconsistencies where there isn't significant growth year on year, and we will touch upon the last 10 years percentage wise too shortly. Bottom line, did it tell a similar story? Well, 4.9 billion in 2018 of net income, 6.3 billion. So we can see, like their top line increased, their bottom line has increased, not to the same extent. And also on a more granular level, we do see some inconsistencies where in fact the bottom line decreased from 2018 to a net loss in 2020 before rebounding very nicely in 2021 and then dropping again in 2022. So some slight inconsistencies on that bottom line versus the top line. Now, taking a quick look at the health of the company, their total cash and short-term investments versus their total debt, well, we can see 8.8 billion of cash and short-term investments in 2018, 9.3 billion in 2022, and 7.7 in their latest quarterly report. So from 5 years ago, we can see it has dropped very slightly. Now, how does that compare numerically and directionally to their total debt? So when we scroll down, we can see their total debt has gone from 7.4 billion to a huge 40 billion. So whilst their cash balance has decreased slightly, their total debt has in fact increased very significantly, nearly 6 times, and we will touch upon that when we look at the dividend safety as well as the net debt to EBITDA metric. Now, looking at some comparisons of companies in the similar industry, the healthcare, pharmaceutical and biotech, we have well-known names: Sanofi, Zoetis, GSK, Amgen and Johnson & Johnson. Now, looking at the year-to-date total return, so this effectively means investing or reinvesting those dividends, we see BMY as the worst performer, down 31%, and it is the only one, or in fact one of the few of their peers who did have a negative return. Now, when we increase this to the last 5 years, and remember, you do want to be maximizing your data as much as possible, we do in fact see a positive return, however only 7%, and it is one of the worst performing. So do bear that in mind, but also understand that historical performance is never indicative of the future, and it is one level of review that we do on the channel as part of the whole analysis of any company. Now, in terms of institutional ownership, we see sitting at 75%. Now, 8.8 billion worth of institutional outflows over the last 12 months, but a whopping 54 billion inflows, so they have been buying more shares than selling, which does show that the institutions do love Bristol Myers significantly more than those that do not, as we can see more inflows than outflows. The largest inflow we do see, quarter two, 44 billion. So there was a very significant purchase. Other than that, we see some small inflow and outflows along the other quarters, but a significant buy in Q2. So again, remember, we're not doing what the institutions are doing. We never copy what they do. We always need to do our own due diligence, but it is interesting to see their movements. Now, very quickly, we can take a look at their September 2023 earnings. Now, they did beat the essential earnings per share, $1.77 expected, $2 reported. So that was a nice positive 13% surprise. Revenue top line roughly in line with what was expected at 10.95 and around 200 million higher than expected, a 0.1% increase. Now, if we take a look here, what this effectively shows is Q3 2023 versus Q3 2022. So from last year, their top line was in fact down around 2.25%, but their bottom line net income increased by 20%, so very positive to see, as well as their diluted earnings per share up 24%. Net profit margin up 23%, so again, very positive both on the bottom line and the bottom line margin. But do note their operating income did decrease and their net change in cash was positive. So pretty positive overall in my opinion. Whilst the top line did decrease, they have found ways to increase that bottom line as well as that bottom line net margin. Now, when we take a look at their dividend safety with a lot of financial information, 79 score making it safe. Now, market cap just shy of 100 billion, making it a large cap company. Now, in terms of key metrics for those that see a recession looming in 2024, they in fact maintained their dividend during the 07-09 recession. Negative 21% recession sales. Now, this was below the average growth of companies in the S&P, which was just negative but to a smaller degree. But they did in fact outperform the S&P 500 at negative 32 versus the S&P's negative 55. Now, dividend growth, remember what I always advocate on the channel, 4% or more, as that was the US inflation rate over the last 40 years on average. So we do see above that 4% that I advocate in December 2022. So we are waiting next month for their dividend increase. 7% over the last 5 years. Again, not bad in my opinion. In fact, positive. Last 20 years, slightly lower than inflation. So it is slightly disappointing to see. But I would like to see another 5+% increase in December of this year. Now, do note they have been paying increasing dividends for the last 16 years or more. Now, dividend yield theory, for those that are new to the channel, states that a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, 4.7 versus 3.14. Forward PE, again, another sign of undervaluation, 6.4 below the 5-year average of 9.2. And when we make our way to the sector PE, it is significantly higher at 16.4. So we have our third and final sign of undervaluation. But as always, remember, we never look at any of these models in isolation. Now, they are right there at their 52-week low, but remember, 52-week low is not a signal for undervaluation. Likewise, 52-week high would not be a signal for overvaluation. Now, typically on the channel, we tend to look at the free cash flow per share. We do ignore earnings. It is susceptible to manipulation by management through accounting. So if you do want to take a look, it is still on screen for investors that prefer that. Now, below 50% for biotechs, I would extend that to around 60% in my opinion, but nothing higher than that. It does give me faith that management have the ability, if possible, to offer those double-digit increases we love to see. And over the last 5 to 6 years, we do see it around 60% or lower, with 2023 again expected to be between 30 to 40%. So that is positive. I can see so far why the dividend is safe and am positive for those essential increases in December of this year. Free cash flow per share, 183 in 2013, 561 in 2022. So that is nice to see, around 3 times growth. It hasn't always been fairly consistent, but from around 2015, it has picked itself up nicely with a small drop in 2022 before an expected nice increase in 2023. Now, sales growth, remember 3 to 7% is what we like to see. We did see some negative growth in 2013 to 14, but since then, I would argue it has been very positive. Other than 2020 where we have seen essential flat revenue. So I would like to see 2023 and 24 guidance showing some increase on that top line. So numerically, how does that sit? 16 billion of sales in 2013, 46 in 2022. So they have increased their top line by around 3 times over the last 10 years. Very nice to see. Now, shares outstanding, we love it as investors when companies do share buybacks, returning excess cash to our pockets. Unfortunately, we do see the opposite here from 2013 to 2022, where they have issued more shares, diluted your position, and as we can see, it has gone from 1.66 billion to 2.15. ROIC, it is one of my 7 golden dividend metrics, 10% or more. The reason why I target this, in my opinion, it means management are able to effectively allocate their capital. So for the large part, it has been above 10%. We do see it slipping in 2019 to 2020, but over the last 2 years, it has been increasing and we do see it in the mid-teens. So that is positive. I would like to see that continue and in fact go back up to the high rates that we saw, especially for biotechs, where we do sometimes hope that they go up to around 25%. Both operating margin and free cash flow margin very inconsistent. For biotechs around 25%. Now they have hit that once and we can see it really near that period. So it isn't something for me that is a worry, but just something to keep in mind. 2020 it did drop significantly. However, on the free cash flow margin over the last 6 years, they have been around that 20%. So that is positive to see, but this is something you just may want to keep an eye on, because remember, the lower that operating margin, the lower that bottom line net income will be, which will squeeze those dividends and dividend increases to the investors. Finally, we end on the metrics with the net debt to EBITDA. Now, this is the earnings before interest, tax, depreciation, amortization. And effectively what we're saying is we want this to be below 1.5, which is the number of years it would take the company to pay off all of their debt net of cash on hand, and does correlate to that top dividend safety. So 2022, 2021, it has been around that 1.5. It is expected to go slightly higher in 2023, but given it isn't dramatically above that 1.5 so far from what I can see, I do believe BMY's 4.7% dividend is currently safe. Now, taking a look at the stock valuation model, and as always, if you do enjoy the content, value is being provided, do smash that like button, do hit that subscribe and bell so you are continually notified of these videos as they drop. And finally, if you want to grab a copy of the valuation model we're about to run through to value companies of your own to get your own intrinsic value and acceptable buy price of companies in your own portfolio, do click on that pinned comment below. Starting off with Graham's valuation, we have the stock ticker symbol BMY, earnings per share 3.94, growth rate at 12, with the current yield on AAA corporate bonds at 5.21. Bearing in mind, the higher the yield goes, the lower the intrinsic value will be. So for Graham's valuation, we have an intrinsic value of $63. Now, when we take a look, that is significantly higher than the current trading price, showing signs of undervaluation, but lower than the 52-week high that we saw at $81. Now, remember, we never look at any of these models in isolation, and we will draw our conclusions towards the end of the episode. We then move on to the multiple valuation model, where we have companies in a similar sector and size that we ran through on the 5-year total return. We have their stock price, earnings per share, P multiples. We get the average, multiply that by the earnings per share of BMY to get a stock price of $77. Now, we can see that is slightly lower than the 52-week high and well above the current trading price, showing some severe signs of undervaluation for BMY in the current market. We then move on to the third model, the dividend discount model, where we have the yearly dividends of BMY with their growth rate, average around 7.4%, very nice to see. Now, I have gone more conservative, slightly higher than the inflation rate, and remember, when you do grab a copy of the pinned model in the pinned comment, you can play around with these percentages based on your own investment thesis. However, based on the 4.25%, we get a DDM price of $63. Again, some nice upside to the current trading price, but within that 52-week range. We then end on the DCF model, where we have the free cash flow year on year. Now, average growth rate coming to 27%. Analysts essentially saying between -1 to 0% growth, so we have gone slightly more conservative. And with our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, arrive at the equity value, divide by the shares outstanding to get a DCF price of $63. And you know that is above the current trading price and within that 52-week range, showing signs of undervaluation. Now, the intrinsic value, don't forget, is purely the average of these 4 models. And as always, if you do enjoy the content, smash that like button. It really helps the channel grow and pushes out the channel to more investors. And do subscribe and hit the bell if you do want to be continually notified of when these drop regularly. So margin of safety for the new viewers, we do start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. So that would be a buy up to $60. Those looking at 15%, it would be a buy up to $57. Those looking at 20% up to $53. And those at 25% around $50. Now, you could stretch it to 30%, but you would be looking around $47. So right now, based on our estimates and judgments, you are looking at a margin of safety of between 25 to 30% for Bristol Myers. Now, Wall Street, what do they say? Well, they believe there to be some nice upside to the current trading price at around $62, around $4 short of what we have analysed in our intrinsic value. So you are looking at a 25 to 30% margin of safety with some nice upside per Wall Street. As always, do let me know your thoughts for Bristol Myers, whether you hold this or whether you are interested, whether you're looking to even buy this company. As always, if you've enjoyed the content, do smash that like button, do hit the subscribe and bell button so you are continually notified of these videos as they drop. And finally, don't forget, if you do want to grab a copy of the valuation model we just run through to get to the intrinsic value of companies in your own portfolio, to get to your acceptable buy price as well, then do click on that pinned comment. As always, have a great day. Catch you on the next episode. Don't forget to comment and see you later.